What's the difference between secured financing and unsecured financing? I'll run down the entire thing, the way it all works, and then I'll give you examples of each. So unsecured financing is basically any type of financing you do that isn't collateralized. It's not tying up an asset. That is typically going to be a lot faster to get done and usually can be a little bit more expensive. Now, there's a difference between tying up receivables and tying up an asset. So typically when you're financing and you're getting a line of credit or you're getting a term loan, those are unsecured, or even invoice factoring. Invoice factoring is going to be secured against the invoice, but that's a receivable, right? So there's no collateral attached. Same thing with a working capital line. It's based around your receivables. So that is receivable financing, not secured financing. They're not putting a lien on a house or any of your equipment. Secured financing is like you're going and you're buying a new property and you have a mortgage on that property and it's secured against that property. Or when you purchase a truck or a piece of equipment using equipment financing. They're giving you the financing and it's collateralized or secured with that piece of equipment. All right, so typically unsecured financing is going to be anything like invoice factoring to speed up your receivables, a working capital line to get money into your business account so you can grow, a line of credit so you can, utilize that to grow your business. And SBA loans typically under 350 and definitely under 150,000 are not collateralized or secured. Secured financing is going to be any type of SBA that is over 350,000, any type of SBA using to purchase a building, any equipment financing is going to be secured. And really those are the differences. So secured financing is typically a little bit cheaper, takes a little bit longer to get done. Unsecured financing is a little bit faster, can be cheap, but also can be a little bit more expensive. It's just about what are you using to collateralize the financing. Asset-backed, an ABL, an asset-backed line, that could be revenue-based, receivable-based, that could also tie up some collateral depending on how big your line is, but it's typically based on receivables and then what you have as a business to collateralize it. So that's kind of a hybrid, which is why I mention it, because a lot of people have questions about that. Right? So that's really the difference between secured and unsecured financing. Both work well as long as you're using them properly, like any other type of program. And if you have any other questions, please reach out to me. I'm happy to help.